Hello and welcome to the Inside CRT 2025 program updates and economic outlook. Before we get started, I want to go over a few housekeeping items. This webinar is being recorded. By participating in this webinar, you consent to the recording, which will capture both audio and video, including anything shown on screen. If you prefer not to be included in the webinar recording, please disconnect at this time. All lines have been muted upon entry and will remain on mute to prevent interference. Please note, we will pause for questions at the end of this call. Please raise your hand during this dedicated time to ask your questions aloud to our presenters. With that, Christian, I'll hand it over to you.
Thank you, Kiara, and welcome everyone to the first CRT webcast of 2025. Today, I'll be joined with three of my colleagues, Len Kiefer, Jeff Shu, and Charlotte Gladwin. They will provide you valuable insight on the economy, housing market, and two of our flagship programs, Stacker and ACES. First, Len will go over some of our economic and housing market update, and then we will have Jeff and Charlotte talk about the back looking at 2024 CRT and what's coming ahead in 2025. I want to thank you for your support over the last 11 years on the Stacker program and ACES programs. ACES this year completed the 100th transaction. It's a very important accomplishment for our site, and it shows the great partnership we've built over the years with the reinsurer market. We've also issued 93 Stacker program transactions. So we expect that either this year or next year we'll be reaching the 100th transaction in the Stacker program history. And sometime this year we will reach 200 transactions when you combine both Stacker and ACES. One thing to note is that last year was very successful for us. We did issue over 5.4 billion in Stacker and ACES transactions that were able to be sold to over 100 investors across both the reinsurance and capital markets. We continue to see a strong support and new entrants almost on every deal that we issued in 2024. And we hope to see that same demand coming into 2025. At least for the first two deals that we've just went to market, we're seeing continued support and strong demand, and very good levels from the perspective of Freddie Mac. We currently cover over 1.6 trillion of mortgages through our CRT executions on the Stacker and ACES front. That's 54% of our single family book. I would like to indicate that as the credit risk manager, we continue to do a great job of managing the credit of risk portfolios. We see very low delinquencies with less than 1% of 60D delinquencies. Also, very small amount of losses on the CRT book, less than 5 basis points on any transaction that we've issued under the CRT programs. So with that, I want to really pass on to today's stars of the show, who will be able to give you valuable insight into what we're doing at Freddie Mac. And with that, Len, please start.
Excellent. Thank you, Christian. Great to be here. Happy New Year, everybody. Great to see you all virtually. Hope that your year is getting off to a great start. Certainly, in the economy, there is quite a lot to keep us busy as we're starting off. We're putting together our views and doing our monthly sort of process in the economic team. I'm Atlanta. I work in our economic and housing research group under our chief economist. And every month we put together our economic outlook. We're constantly looking at reassessing where the economy is headed. And at the start of the year, it's a great time to be thinking about what we expect to see in the market here in 2025 and beyond. In some respects, 2025 may be an inflection point in some areas we'll talk about. There's been some challenges to the housing market with high interest rates. We'll get into some of the history there, but as we get into 2025, I think a lot of the focus is on what will happen with interest rates, mortgage rates in particular, how that's going to affect transactions in the housing market, how it's going to affect performance. As Christian alluded to, performance overall in the mortgage market has been very strong. It's reflective of an economy that has defied some expectations for a slowdown and actually has held up really well. If anything, economic data, real economy on the labor market, consumer spending has been persistently strong, which is good for the consumers. It's good for performance because it helps folks, generate income, see their incomes rise, service their debt, perform well. That's great, and that's been a source of strength for the economy. We've powered through. The U.S. economy is doing really well in terms of economic growth, but it has presented some potential challenges in the interest rate environment because of some a little bit stickier inflation. If we go forward to my first slide here, we can look at sort of, I think, is the top sort of macro item that we're looking at is what's going to happen with inflation in the U.S. Now, inflation has come down quite a lot. And the chart here is not updated for the latest report from the Bureau of Labor Statistics just this week, which showed again a decline there in the consumer price index. It's still running a little bit above the Federal Reserve's target for price stability, which would be from the core PCE price index about 2%. You can see in the chart through November, we were running closer to 2.8% on the light blue core PCE. That's a challenge, right? Because that's going to put some potential challenge for the policymakers as they weigh, rate cuts versus, an economy that's still going pretty strong, and there's still some inflationary pressures. There are some upside risks on inflation, despite, some progress we got in the latest report, because services and shelter, which are on the right panel, are sort of broken down core consumer price index, or sorry, headline consumer price index. What are the various components that are driving that number? And you see that key lime slice, the biggest slice there is shelter, which is a lot of that's driven by rents and the owner equivalent rent that the BLS imputes based on their survey data. And that's sticky on the upside in the sense that that's the persistent. In fact, researchers at the Bureau of Labor Statistics and the Cleveland Federal Reserve Bank published a recent analysis looking at sort of, if we look at sort of new tenant lease behavior versus existing tenant lease behavior, and we project that out using some assumptions that the sort of recent data is going to persist into the future. How long is it going to take for the shelter inflation to get back down consistent with sort of the pre-COVID average? And their projections were, like 2026. Now, there's a lot of uncertainty. There could be shocks, but there are actually some upside risks in that if mobility were to increase, that actually could create some challenges there, and it could go even further out. And so that speaks to some of the stubbornness of the inflation data. We've had progress there, but it's not just shelter; it's also core services, which have shown some stickiness there. And as we get into 2025 and think through what potential impacts of policies and other things may have on the macroeconomy, there are some possibilities that inflation remains a little bit higher than where we may have been projecting certainly a year ago. However, we got to have context, right? If you look at the chart on the left, we were in COVID, right? Period. Out of that, we were close to high single digits, 10% in some measures, right? We're well below that. Inflation has come down. That should ease, but as the market sort of anticipates what policymakers may do, as they anticipate how the real economy evolves, that then gets translated into interest rates, which affect the housing market quite directly. If we go forward a slide, we can look back to last year and up through the early parts of 2025 and realize that it's been quite a roller coaster ride for mortgage rates. If we roll back the clock to 2024 January, we're entering the year, mortgage rates were a little bit above 6.5%, 6.6%. And at that time, a lot of folks were anticipating that rates as we got into spring 2024 would be coming down. That actually didn't happen. As I alluded to the data for the economy was good. So they were persistently high. Inflation was a little bit more stubborn than what some projections had, and the economic growth. That sort of changed the calculus on what policymakers would do with the Federal Reserve with their interest rate policy and how the economy would evolve. And you saw interest rates kind of ratchet higher instead of going down. Early 2024, folks were thinking, okay, rates are going to come down. That's going to create a lot of transaction volume, home sales. The market's going to really pick up. Instead, interest rates rose up through May, got up above 7% in this is Freddie Mac's mortgage rate survey. Then, things started easing as the Federal Reserve started signaling that they would cut rates and that the interest rates might ease. And you saw interest rates come down up through September. And we got down into the low sixes, so quite a bit below where we started the year. And again, folks were thinking, okay, maybe this is it. Maybe we're going to get the rates back down. Maybe they'll get down below 6. We'll get into the 5s. That didn't happen. Instead, again, economic data, the economy was showing some firmness in terms of the real growth, which is good. Labor market still doing well. That's great. Low unemployment rate, but put some tension there on the interest rate and saw interest rates move higher. And in the early 2025 here, we're pushing back close to 7% on a 30-year mortgage rate. From a long historic perspective, Freddie Mac is a Gen Xer. Our mortgage rate survey as a Gen Xer has been doing it since 1971. All right, but if we look back over 50 plus years, we see a 7% mortgage rate is not super high by those historic standards. But if we look at the recent years, it's quite a bit higher. And interest rates just a couple of years ago, coming out of the pandemic into early 2021, reached a record low of under 3%. In our mortgage rate survey, it ratcheted quite a bit higher, much higher than we've seen in this 21st century so far. And that's put some pressure on the housing market. If we go forward a slide, I have a way to illustrate the challenge that these higher interest rates have presented. And this is what we call the mortgage rate lock-in effect, which is a very important feature of the housing market. It's an impediment to transactions. It's reflective of the fact that interest rates moved so much higher so quickly. So what this calculation is showing is looking at the Freddie Mac portfolio of fixed rate mortgages, 15 and 30-year mortgage rates, and ask the question, if that homeowner were going to take their existing home and sell it and get a new mortgage at prevailing market rates, what would they be giving up in terms of the low payments that they have locked in through having a mortgage rate, some cases under 3%, 3%, 4% mortgage rate, where prevailing rates are closer to 7, right? And we ask, what's the economic value to them, and that what's the sort of cost if they were to actually move? And that's what this calculation is showing. It peaked back in 2023 at over $60,000 per borrower on average, right? And that depends on where you are in the country. If you have higher loan balances, like in higher cost states, it can be quite a bit higher, right? But on average, it's $60,000. That's the value that a homeowner would have to give up in order to list their home and sell it. That's quite a lot. And so many homeowners have elected not to list, not to sell, to stay in place. They've been locked in. Now, that effect has waned a little bit over the last couple of years. As we get into December of 2024, that's moved down to about $46,000, right? And it oscillates with interest rates. As interest rates move higher, that lock-in effect's gotten a little bit bigger. So over time, that lock-in effect will fade, but into 2025, it's still quite a significant challenge. That's created kind of a slowdown on the transaction front. We've seen inventory jammed up. Looking ahead, rates back up, maybe they ease a little bit, but it's going to take quite a lot of movement to bring that lock-in effect sort of normalize over time as the loans sort of age, as folks, life events happen. The interest rate is not the only thing that determines what people do. They have jobs, family, life situations, right? That may dictate how people move, but this is certainly a challenge in the short term. With the lock-in effect being so significant, but the economy going strong, housing demand fundamentals are still pretty strong. So if we go forward, we can actually see that house prices go forward once I thank you. Through November of last year, full year data will be on shortly, about 4% annual growth. That's down from where we were in 2023, certainly lower than we saw in 2021 and 2022 when the housing market was really going strong. Interest rates got below 3%, right? The market was really hot then. But if we look to a pre-COVID period, kind of in line, maybe a little bit lower than the 2019 to 2014 average here, but a very consistent, we think, sort of longer run, like a much closer to sustainable level of price growth than certainly high single digits or those rates that we saw in 2021 and 2022. So price growth is moderating. We expect going forward, because of affordability challenges, and we do think the economy is going to remain outside. We're not going to have a recession in our baseline view, but the economy will likely slow just as the weight of higher interest rates presents some challenges. Labor market is showing some signs of moderation. So then you get sort of this affordability challenge biting a bit. And so we expect house prices to moderate, but on a national level remain positive into the next year or so. If we just think longer term, fundamentally, the U.S. housing market is well undersupplied for the amount of housing that our population needs. And we've done some analysis on that. Our latest estimate has the U.S. economy is short of about 3.7 million housing units to kind of gain balance between supply and demand. That's all in single family, multifamily. That's quite a lot of production. If we go forward a slide, I can show you data from the Consumer Expenditure Survey from the Bureau of Labor Statistics, which looks at sort of how much of a overall spend for homeowners is being devoted to different components. And I'm looking specifically in this chart at things that are related to shelter. So this is for homeowners. The light blue line is showing you mortgage interest and charges. So this is their principal and interest payments, right? Back in 2008, it peaked at around 10% of total spending was going to mortgage P&I payments for the typical US homeowner. These are averages. That's declined as homeowners have got to take advantage of successive waves of refinancing and lower their P&I payments. Even with house prices up, the power of lower interest rates resulted in lower overall spend on mortgage interest and charges. But if you look at the bottom, there's two other components which don't share those same features. Property taxes, which reflect, past increases in house prices. So as those strong house price growth from 2021 and 2022 start to get sort of factored into evaluations, you see property tax increases rising. And then in the orange line, very important, is the rise of maintenance, repairs, and insurance. Homeowners insurance has seen pretty sharp increases in some places, and it's something that we've devoted some study to. We've got some research that I'll share with you, and actually some forthcoming research to look into it with greater detail. So if we go forward one more slide, I'll just show you some data that we've tabulated on how homeowners insurance costs have increased. So in the top left panel, we just look at from closing disclosures data collected by the Freddie Mac. We were able to analyze and look at sort of what's the typical homeowners insurance payment back in 2018 up through 2024 through I think we had data through August when we compiled this chart. So you look back in 2018, the typical average homeowners insurance payment was about $1,000 a month, or sorry, a year. That rolled forward, right? And you go to 2024, that's increased almost 80%. This is not inflation adjusted, but still well above inflation to nearly $1,800, right? So it's quite a very significant increase. You've seen lots of reports, certainly with the disasters there in California, ongoing disasters there, but other past disasters have caused sort of the physical risk to increase, and that's been reflected in higher premiums and other dynamics in the insurance market. It's varies a lot by where you are in the country. So the map on the right panel is looking at the homeowner's insurance premium scaled by home value to give a sense sort of how much, sort of how intensive these insurance premium are relative to the value of the housing. And you see that in sort of Gulf Coast areas in the central United States, even though the property values are a bit lower there, the cost of homeowners insurance is is a bigger burden than places like California, where insurance costs in absolute sense have definitely gone up, and certainly that's something to watch for as we go forward. But in terms of relative to the balance, have not been as significant. And I think with all of this data on insurance, which is very important to study, things we're looking at, we're thinking a lot about it. It's important to put some context in this because certainly with the high percentage increase, right, 80% increase in average premiums that we see on the top left panel, that's quite notable and quite, caught a lot of attention, and certainly worth studying there. But if you want to put some context in sort of what does that affect in the affordability mix? So that's what the bottom panel is showing. So this is looking at the average housing cost as a percent of income for the average borrower, and looking at that both comparing the principal and interest, which is the light blue, versus the insurance premium. So while insurance premiums have gone up quite a lot, as a share of income, it's increased relatively modestly from 1.47% in 2018 to 1.7% here in 2024. And so you see the impact of interest rates have dominated this. In the sense that we saw the the P&I payments go up quite a bit more. So I think that context is useful and it's helpful, and it's something that we are studying and trying to understand more because these insurance costs are likely to continue to increase. They've outpaced inflation. If that continues, that will put some pressure on homeowners, may impact performance and other things. So things that we're studying very closely, trying to analyze that. And Freddie's got some very unique and interesting data like that I'm showing you here that allows us to track that in real time. So overall, just to tie together the overall outlook picture here, and ready to hand it off to my Freddie colleagues to continue their presentation. Just overall picture, broad economy is doing well. We anticipate the economy to continue to grow, but see some moderation. There's been some upside surprises on the real economic growth, and so there's some very good story, especially if you compare the U.S. economy around the world. Right. So our baseline view has the economy continuing to expand, maybe a little bit slower growth here in 2025 relative to 2024. Maybe a modest, very, very slight increases in unemployment, but a very benign economic environment. Interest rate environment likely to remain a challenge. We've seen gyrations, a lot of volatility in the rates. They may ease a little bit, but not not like we saw back in the past couple of years for sure. It's a little bit higher interest rate environment. That's going to present challenges. It's going to make lock-in effect sort of persist and keep home sales values, home sales transaction activity a little bit low. But on the price front, valuations have held up strong economy, little inventory, a fundamental undersupply, that's going to persist. And as we think about, remote work and other factors may drive the geographic distribution of prices, and we're going to have to watch and see how insurance costs and other property taxes, other costs affect the market, and something that we are studying there. So I'm happy to take questions later when we get to that section, but I'm going to turn it over back to Christian, or not quite sure, but I'm done. Hand it off back to my compatriots here.
Thanks, Len. And with that, I want to pass it to Charlotte, who will start with the view of the CRT programs.
Great, thanks, Christian, and thanks, Len. And I'm very happy to be here with you today. I haven't done one of these webcasts in a couple of years, and I'm happy to be able to give you an update on the Stacker program this year. And as Christian was mentioning, Jeff and team, the ACES team, have celebrated their 100th deal this year in 2024. And Stacker is definitely inching towards that 100th deal mark. So we're really looking forward to that. Maybe we'll have a big party when we get there. But anyway, back to Stacker program in 2024. As you guys know, we are executing under a capital restoration strategy, and therefore we're concentrating our issuances on A1, M1, and M2. And for the year, we issue 3.8 billion of bonds in the market, which translates to 130 billion of single-family mortgages that had credit protection. And this is up $1 billion from 2023. So, we're happy with the progress there. And as we all know, the spreads have been really, really tight. However, we still saw very healthy and robust participation from our investors. And we always thank you for continuing participating and supporting our program. We ended the year with 76 unique investors. We gained 12 new investors, which is always good to see. And also 18 investors have participated in 2024, but didn't participate in 2023. So all in all, we think it's a very successful year. And we ended the year with just over 28 billion of bonds outstanding. And the mix there is roughly 40 to 60% split between the Bs and the Ms and the A1. So Ms and A1s is the 60%. From the structure front, we introduced the A1 structure back in 2023. And as you recall, at the time, the A1 is pro rata to the structure, and it was subject to the triggers, such as min-CE, the delinquency trigger, and the like. So in 2024 HQA2, which closed in September, we enhanced the A1 structure. So now the A1 has a fixed payment schedule, as well as we eliminated most of the triggers. We did keep a 1% cum loss trigger. So with the certainty of payment, as well as essentially eliminating extension risk, this bond has been very well received. And we are also able to get better rating. It's more noticeably in the DNA transactions for that tranche. So we have seen really good participation in that tranche. And we can't forget about our tender offer program. In 2024, we did 4 tender offer transactions, and we bought back just under 4 billion of outstanding notes. And we'll talk a little bit more about the tender offer later on. So all in all, for 2024, we had 3 low LTV DNA transactions, 2 high LTV HQA transactions, as well as 4 tender offer transactions. So Jeff, what have you been up to in the ACES space?
Thanks, Charlotte. Well, Happy New Year, everyone. Thanks for joining. Special tip of the hat to the reinsurers joining us on this. And what we've been up to is kind of up on the screen here. We'll take a minute to talk about 2024 and then get to kind of plans for next year. But as has been noted already, we did cross the 100th deal milestone. It's a big deal in program history. Reinsurers made it happen. A lot of work internally to get that across the finish line. But I wanted to note there were some other things that also celebrated their 100th birthday in 2024. So Greenwich Mean Time celebrated 100 years. These are things that may not be as important as ACES, but I'm going to call them out anyway. So Greenwich Mean Time, MGM Studios 100th birthday. The first TV images ever broadcast, 100 years of TV images being broadcast. So, I thought I'd note these kind of smaller events just to kind of give a little bit of a tip of the hat to some others. Don't want to be too ACES focused here. But also the Olympic Games celebrated 100 years. So I think we are very much like the Olympics here. I think we're working with very well-trained, mostly physically fit, I don't want to call out any names, participants. We have a lot of good, strong relationships, just like the countries build up relationships. We've built up very good relationships with Freddie and reinsurers over the years. We also have a routine and rules to what we do with all of our transactions, so very consistent with the Olympic Games. What we're missing is an Olympic Village where we all live together. No, I wouldn't recommend it. So I think we'll skip that one and take that difference as given. But 100th deal, that's a big milestone. If you look across the years, we've done 36 billion, roughly a little bit more in ACES transactions with supportive participants on the line here. So thanks again. This past year, we added another 1.6 billion in new transactions. If you look at the bottom, that was across 5 transactions, 2 low LTV, 3 high LTV transactions. Our participation count remains very strong. We were at 36 unique participants for the year. We had some of the largest panels, so the largest A1 panel on SPL2 and H2 at 21, largest M1 at 20 participants for H1 and H3. So very well supported, very solid economics. So when we look at the value add for the reinsurance offering internally for CRT, it stacks up very well. So I think what we want to do is maybe move into look at the mix of participation on the stacker side. Let me throw it over to you, Charlotte.
Yeah, thank you. Let's take a look at stacker investor participation. And in 2024, we hit a milestone where our unique investor base or unique investor count exceeded 300. We're full of milestones today. So that has been a big accomplishment for us. And from a 2024 deal participation perspective, we have roughly 30 to 40 investors per deal participating. It is down from 2023, where we average somewhere or ranging somewhere between 40 to 60 investors